Good day, everyone, and welcome to this RMA Risk Readiness Briefing, our special coverage series. My name is Stephen Martin, and I lead the Business Solutions Group at the Risk Management Association. The RMA is proud to make this presentation complimentary to our members, and if you're not a member, I urge you to explore all of the benefits RMA has to offer at our website, rmahq.org. Today's webinar is the latest installment of Credit Trends in Commercial Lending, which we developed using the Credit Risk Navigator, formerly known as the Risk Analysis Service. And today's presentation, as always, is led by Tom Cronin and supported by Jeremy Chalson of AFS. During the presentation, if you have a question for the speaker, please submit it using the Q&A feature at the bottom of your Zoom screen. And as always, we will address as many of the questions as we can at the end of the presentation. So at this time, I'd like to turn it over to Tom Cronin, and thank you for joining us today.
So thanks, Stephen. And as usual, thanks to everybody else for joining us today. As Stephen mentioned, today we'll be analyzing the June 2021 data from the Credit Risk Navigator, which was formerly known as the Risk Analysis Service. And as we're halfway through the year now, you're going to see a number of charts today that'll look at what's happened so far in 2021. So the Credit Risk Navigator database, just to get started, actually started in 2003. It has about $1 trillion in exposure, and we're now closing in on 1 million loans. Banks send their end-of-month results directly to AFS. We process that data, including a vigorous QA step, and after that verification, load the data to each bank's individual workstation. And with that workstation, a bank can compare its performance versus its peers and the market for dimensions such as industry, geography, or deal size. So we're going to examine the C&I portfolio on the next couple of pages. And by way of definition, C&I loans are business purpose loans made to companies with annual sales north of $1 million. These loans are manually underwritten and also manually risk rated. And just as an FYI, loans secured by owner-occupied properties are included in the C&I portfolio. So our first chart today shows our 4 performance measures over time. In the red, you see the line for non-accruals. The blue is 30 to 59 days past due. The yellow is 60 to 89 days past due. And the green is 90 plus days past due. And if you start with 3Q03 on the far left, as you move to the right, you see the dramatic impact of the recession, especially for the non-accruals, which peaked at 3.3% in September 2010. 4 years later, we're down to 0.65 for non-accruals, and we bounced up to 1.43% in late 2016 as a result of the energy crisis. But by early 2020, actually it was March of 2020, the non-accrual rate was back down to 0.72%. And then the business closures as a result of the pandemic drove up both the non-accruals and the short-term delinquency rates. If you look at the blue line, short-term delinquencies hit a service high of 1.33% in April of 2020, but have since receded substantially. And in November of 2020, the non-accrual rate was at 1.03%, but it has also receded since then. And on our next slide, we're going to take a closer look at the more recent history. So here's what's happened in 2021. Again, we have our 4 performance measures, and we're starting off with 12/31/20 as a starting point, as a base. As businesses have begun to reopen and the GDP has grown, I saw 6.5%, if I have my numbers right. The performance statistics have been slowly improving overall. So for example, the non-accruals, again, the red line, in December, they were at 0.98. They're now at 0.87. Short-term delinquencies, the blue line, have fluctuated a little bit. They were at 0.27 in December. They're now at 0.41, but you can see they've been right along the 0.40% range since February. 60 to 89 days past due, the green line, have gone from 0.08 to 0.05. Actually, sorry, the yellow line, 0.08 to 0.05. And 90 plus days past due, the green line, has gone from 0.11 to 0.03. And so since the past dues have seemed to be in control, we're going to focus a little bit more on the non-accruals on the next couple of slides. So a couple of comments about this chart, which shows the percent of loans that are on non-accrual as of December 2020 in the blue column, and then June 2021 in the red column. Over the past 6 to 9 months, we've talked quite a bit about a K-shaped recovery, meaning where just a few industries would be severely impacted by COVID-19. And if you look at the blue columns, you can see that we had a handful of industries close to or above 2% non-accrual back in December. Over the past 6 months, all but 2 of these improved. So 71 arts, entertainment, and recreation increased very slightly from 2.69 to 2.77. But the industry with the largest deterioration is 56, administration and support, up from 1.96 to now 3.61. And we'll take a closer look at 56 on the next couple of pages. But I did want to point out that industries that are now doing well are 52, finance and insurance, 62, health, 61, education, and 44, retail. And that retail is the automotive piece. So the Navigator database has the ability to provide data for industries down to the NAICS 6-digit level. So here we've dropped to the 4-digit level to obtain a better understanding of what's happening within NAICS 56, since that's a very broad category. There are 11 subsectors for 56, and all of those are displayed here. And about half of these, as you can see, basically don't have a non-accrual issue at all. The office administrative, facilities support, employee services, business support, and then in the middle, services to buildings and dwellings, very little activity. So let's look at the other 6. And I've split these 6 between 2 subsectors. One subsector that has issues, but those issues haven't changed over this past half year. And then other subsectors that have shown a substantial increase in 2021. So the 3 subsectors that fall into the first category, and that being where they've had issues, but they really haven't changed a lot, is 5615 travel arrangement. Pardon me. It was 4.3. It's now 2.9. So a good improvement. 5621 going over to the left, waste collection, was 521, is now 563. And then 5629, the last one on the right, was 902, is now 904. In the second group are subsectors that we saw non-accrual levels increase substantially in the first half of 2021. Those are right in the middle, 5616, investigation and security. They've gone from 378 to 1013. Part of that is security guards. 5619 going over again towards the right. It was 0.42. It's now 4.34. And then the last one, 5622, waste treatment, was 108 and is now 12.4%. So these last 3 have deteriorated substantially in the past year. Now I want to switch gears a little and move to non-accruals by geography. And within the Navigator, for any C&I loan, the geography is based on the location of the borrower, not the bank. And we split the USA into 7 regions. And in comparing the non-accrual levels for December versus June, as we saw with the overall results, non-accrual levels are down in almost every region, the only exception being the Mid-Atlantic. We'll look at that region in detail on the next page, but let's stay on this chart for a second and look at some of these others. So the Southwest still has the highest level of non-accruals, but those levels have dropped 30 basis points to 1.22% as the oil and gas non-accruals and performing arts companies within the Southwest have dramatically improved. And the Eastern Midwest improved and is now below 1% due to big improvements for electric power generation and crop production. And the South has also dropped below 1%, largely due to an improvement in passenger car rental as people begin to travel again and get out. So I mentioned the Mid-Atlantic was the only region to post an increase in its percent outstanding, percent non-accrual. So here we're dropping down again to the state level to isolate those increases. And there are 3 states that are now above 1%. So the first one on the far left is Delaware. It jumped from just below 2% to 3.2% due to increases in non-accruals for amusement parks and funds. New Jersey is up slightly from 1.9% to 2.15%. And that was due to increases in commercial machinery and equipment rental and performing arts and sports promoters. And then Virginia, historically a well-performing state. In December, it was at 0.55%, and in June, it's at 1.7% due to increases with waste treatment, security guard services, telecom, and management consulting. All right. So now we're going to switch to loan quality. And when a bank sends us their initial file, we map that bank's borrower risk ratings to the RMA 10-point scale. On that scale, loans rated 1 through 6 are pass credits. 7 through 10 are classified as criticized and are further segmented as special mention, substandard, doubtful, and loss. And that additional segmentation and its history is what you're seeing here. Special mention in the blue, substandard in the yellow, doubtful in the green, and loss where there was some in the red. And if you recall on our first chart, which was the trend in performance, if you recall the shape of that, this chart matches the overall direction and the overall shape of what we saw there for non-accruals. Usually the direction of percent criticized matches the direction of the percent non-accruing. And if you look at the percent criticized most recently, you can see that it peaked at 8.59% in September of 2020. The peak for non-accruals was 2 months later in November. But since then, both values have been improving. And for June 2021, the percent criticized is down to 7.8%, close to where it was in May of last year. On this chart, we're looking at the percent criticized for each 2-digit NAICS sector, again for December 2020 and June 2021. In December, we had 6 sectors that had a percent criticized above 10%. And I mentioned that because you remember the overall average is right around 7%. So these 6 sectors at 10% were substantially above the average. And for those 6, the criticized level has dropped for 4 of those, specifically going left to right. The ones that have dropped were 11 agriculture, 21 mining, oil and gas, 48 transportation, and then further on the right, 72 accommodation. But the percent criticized increased for 2 of these 6, those 2 being 45 retail. And this is the part of the retail that has department stores and things like that. We'll look at that in a second. And then 71 arts, entertainment, and recreation. And if you've been with us in the past, you remember that this encompasses not only theaters, but also fitness centers, all of which had bans during the COVID crisis. And we also had a jump for 56 admin waste, support and waste, and that's now above 10% as well. So I just mentioned that we saw 45 retail had the largest increase in percent criticized. And so I thought it would be good to examine this particular NAICS code at the 4-digit level to get a better idea of what's actually there. And there are 13 subsectors for NAICS 45, and only 3 of those had increases of any significant amount. The first one, starting on the left, is 4512 bookstores. And that went from 37% to 93%. And I'll give you a caveat here. There's really not a lot of dollars in this particular category, as I think banks have gotten out of the business to lending to bookstores and newspapers as that industry has died off. But what's left is almost all completely bad or forecasted to be bad. The next one that saw a significant increase almost in the middle, 4529, other general merchandise went from 7 to 13.2%. And then going further to the right, 4541, electronic shopping went from 7.9 to 17.8% criticized. And if you recall, the overall average is at 7.2%. Of these 13 retail subsectors, 8 are above the average. So here we show the risk rating distribution for December 2020 versus June 2021 in an attempt to see if the overall credit quality has changed as banks struggle to deal with tepid demand for new loans. And what we see is that over the past half year, the credit quality has actually improved. The percent of low pass, which are 6s, and special mention, the 7s, have declined, while the percentage of loans rated 4 or better, and by better, I mean 4, 3, 2, or 1, so the better than average and high pass, have actually increased as overall quality has improved. So far in the chase for loans, the banks have been maintaining the credit quality. And needless to say, this is something that we've looked at in the past. We're going to keep looking at this to see if credit quality begins to shift a little bit as you chase loans. And one last C&I chart. When you compare outstandings for each Navigator bank, December 2020 versus June 2021, or actually January 2021, 85% of the banks have lower outstanding balances. And I don't think that's a secret. Balances have been dropping. But on this chart, we want to look at the loans that were actually originated, the new loans that were made in the first half of 2021. And frankly, I was totally surprised at what we see here. You know, the loans that were originated in the first half of 2021, 27% have been to 52 Finance and Insurance. And the next closest section is wholesale at 9.1%. And 52 financial investment activities are things such as brokers, clearinghouses, exchanges, private funds. And I can't remember, I went back and actually looked, I can't remember a time or an industry that was so dominant in a short period of time in new originations. So this is really, in my mind, quite astounding that all the growth, there's not much growth. What is being grown is this 52 Finance and Insurance. So now we'll move on to the CRE results. Again, a quick definition before we look at the charts. CRE loans are made where the primary repayment of the loan comes from renting or leasing the property. And these are often referred to as investor-owned properties. So this chart is constructed in the same fashion as our first C&I chart, and it shows the trend in performance for CRE loans. And once again, just to reiterate, the non-accruals in the red, 30 to 59 days past due is in the blue, 60 to 89 days past due is the green, and 90 plus days past due is the yellow. So post the recession, CRE loans had shown a dramatic improvement. As an example, CRE loans were at 9.3% non-accruals in late 2010 and had dropped to just 0.28% as of March 2020, right before the pandemic. The pandemic interruption severely impacted the 2020 numbers, but appeared to have peaked at 1.28% as of January 2021. And it looked like delinquencies had also peaked around that time frame. But for June, we see a big jump in the non-accrual level and also a big jump in short-term past dues. So non-accruals went from 1.14% in May to 1.26% in June, and short-term delinquencies went from 0.31% to 0.50%. And the long-term delinquencies remain elevated at 0.6%. So unlike the continued improvement that we're seeing for the C&I loans, the pandemic's impact on CRE loans does not appear to be over just yet. So let's examine the non-accrual level in more detail. Here we've pulled the 8 largest property types that we have in the Navigator. And by largest, I mean percent loans outstanding. And we're displaying their non-accrual rates since January of 2021. So their recent non-accrual performance. And 5 of the 8 now have lower non-accrual levels. And 2 of the others, mixed use and multifamily, are up, but just very slightly June versus January. And then at the top of the chart, and if you've been with us before, you've heard me say this, we have lodging. We saw improvements in lodging non-accruals in February and March, but now the level has increased again. And at 9.48% for June, we've now reached a pandemic interruption high. And this is despite the hotel occupancy climbing to 66% for June of 2021, according to STR, and with some markets even being in the 70% range. So this is very surprising. I thought this was going to keep coming down as people began to travel and got out, but apparently it's obviously being very stubborn. So let's take a deeper look at lodging, kind of where and what. So for CRE, we base geography on the location of the property. And here we're showing the percent non-accruing for, again, this is just for lodging properties in each of our 7 regions for June 2021. Now, 3 of the regions, the South, the Western Midwest, and the West, have very little or no non-accruals. 3 others, Mid-Atlantic, Eastern Midwest, and Southwest, have levels close to or above 10%. And finally, the Northeast non-accrual levels, however, are 2.5 times higher than any other region. So since non-accruals in the Northeast are so much higher than any other region, I thought we examine the issues at the state level within the Northeast. And then also I'll tell you the city levels below this. So we have the ability not only to look at state, but what we call the core-based statistical area. Those aren't on this chart, but I'll tell you what they are. So here we're presenting the non-accrual for each state within the Northeast region. As we've seen a number of times when we drill down, it's a tale of have and have-nots, indicative of the K-shaped recovery. Now, there are no non-accruals for lodging properties in Maine, New Hampshire, Rhode Island, or Vermont on the chart or in our database. So I did not include these on the chart. To be honest, there's not a lot of loans in there as banks have gotten away. There used to be, but now banks have gotten away from lending to lodging in those areas. So what you do see here are 3 states that have a significant amount of non-accruals. 5% of the lodging loans located in Connecticut are on non-accrual, which under normal circumstances would be considered severe. But bigger problems are in Massachusetts and New York and dwarf what we see in Connecticut. In Massachusetts, the non-accrual percentage for lodging properties is 43%, with the majority of that in the Boston area. For New York State, the percent non-accruing is 32%. And Syracuse actually leads the way at 75%, 77%, followed by New York City at 35%. So the big Northeast cities where you see a lot of convention activity for hotels is still have those lodging properties are still having problems recovering. So our last two charts are going to mirror what we did for C&I. We're going to show you the change in risk rating and then the new exposure for 2021. So here's the risk rating mix. And the most obvious changes are the increase in the 5s right in the middle and the decreases in the 6 and 7s. Unfortunately, 8s went up a little bit. So from these results, it would appear that the overall outlook for CRE loans have improved. Although again, the small rise in the 8s indicates that maybe there's still some issues, particularly since we saw a rise in non-accruals this time. So it doesn't look like we're out of the woods yet with the CRE portfolio. Pardon me. So for our last chart today, we're presenting for the top 8 property types, the new exposure mix. And again, these are loans. It's not change in balances. These are loans. These are facilities that were made between January 2021 and June 2021. And 29% of the new exposure was for multifamily loans. 28% was for residential loans. So almost 60% of the new loans made in the first half of 2021 were for housing. New office exposure comprised 15% of all new CRE exposure for the first half of 2021, despite a large percentage of the population not working in an office. Very few lodging and healthcare facilities were originated in the first half of 2021, and industrial properties, despite the rise in e-commerce, still lagged the other properties types as banks seem to have an issue with making industrial type loans. So that concludes our service today, our webinar today, and a quick summary. The CRE non-accruals and short-term delinquencies increased in June, while the performance measures for C&I continued to improve. Overall, the credit outlook is improving and commercial loan growth remains weak. CRE loan growth is a little bit better, but still I'd categorize that as tepid. So Stephen, I'll turn it back over to you.
Great. Thank you, Tom. A lot of good information as always. I would like to remind all of our participants today that this is the time where you can ask directly the questions of our experts on here and get some insights from you. So use the Q&A feature. Tom, there was one question from the GDP that you quoted, and I don't know if you know this, but was it inflation adjusted, that 6.5%?
I don't, I'm trying to find the note I made. I just saw it as I came on, and I don't know the answer to that. I will find that and get that back out to you. I see who asked that question.
Okay.
This is Jeremy. That number is inflation adjusted. It was the real GDP figure.
Okay. Thank you.
Terrific. Yep, and one of our participants also affirmed that, so appreciate that. Let's see. Well, this is the time, folks. There's no other questions queued up, so you get quick. You get to jump to the top of the queue if you can get your question in here before we close. Here's one, Tom. Can the regional differences in lodging performance be attributable to how different parts of the country handled the pandemic in terms of how quickly or aggressively they shut their states down or opened them back up?
So what I'm seeing, and pardon me, the answer to that is not really. What it looks like happened was that the cities that are still having problems are I guess what you'd call would be destination cities for conventions. A lot of downtown hotels where you had large conferences, business conferences that had been canceled. It just came up the other day. I guess the RMA again is doing a virtual conference So that's 2 years in a row that we haven't gone to, a hotel for a couple of days. And so it's areas like that, Boston, New York, San Francisco, the big convention areas. It really wasn't, what people were doing in terms of shutting down.
Great. Thanks, Tom. Here's a question from Robert. Do you have numbers for Las Vegas?
I can get those. If you send me an email, I will ship those off to you. I don't have them offhand.
Okay. Tom, do you mind just advancing one to get to your email address there?
Yeah.
Or two? Yeah, perfect.
There we go.
Thank you. I guess that maybe a follow-up to Tom for those that are either new or don't remember, but generally the coverage, can you speak to that a little bit of the Credit Risk Navigator database in terms of states and regions and that type of thing?
So we split, if you remember, I said there were 7 regions. We split the country into 7 regions. And below those, we have state data and then data at the city level, the CBSA level. And as you would expect, the majority of the dollars, I think, Stephen, if this is what you're looking for, tend to be, if you start in the Northeast and come down to the Mid-Atlantic, the South, and then over through the Texas area and up to the West. And then there's a good amount of dollars in the heartland. And as you would also expect, the dollars in places like maybe Montana and the Dakotas is not as great. There are dollars there. We actually have outstandings in every state in the country, but it's really the area that I outlined where you have the most dollars.
Gotcha. Thanks, Tom, for that reminder. All right, here's from a longtime participant, Guy. Hey, Guy, I'm glad you're back. Why are non-accruing and 30 to 60-day trends so different? Is this partly due to changes in regulation?
So what I assume you're talking about the C&I, the changes in the C&I, and what we found, if you remember, when the COVID first hit, that first month in April, past dues shot up. I think it was 133, if I remember the number correctly, as people and we saw the outstandings go up similar. People just hoarded cash and didn't know what was going to go on. And then the month subsequent to that, between all the PPP loans and the other government assistance, those businesses that were going to be okay started paying their loans. And so delinquency rates dropped. And then the industries that were going to be really impacted by COVID started to go up in the non-accrual sector. So things like fitness centers, the retail stores, the malls, I'm trying to think, the arts and entertainment pieces of it, hotels, all those, the non-accruals really hit after the first couple of months. And the non-accruals have just been very, very slow to come down. As I think a lot of banks are working through issues with, restaurants that have shut down, hotels that just haven't bounced back yet. So it's a very slow process.
Gotcha. And I think part of that question too was it's not like a classification difference that somehow came out recently. That's the real what happened over the past X months.
Yeah. Yes.
Yeah. Terrific.
Yep.
Thank you. Good question. All right. Last chance here, guys. If you're on the fence about asking, I'd urge you to hit that enter button and get that in. And while we're waiting for that last person, I know there's one of you out there. Just want to remind you that we have recorded the demonstration of Credit Risk Navigator that we did several weeks ago. It's available on the rmahq.org website. And you're welcome to go and take a look at that. Tom did a great job of taking you through what the new user interface looks like using 3 use cases that would be, I think, very common to everybody that's on the phone today. So that's one avenue. And you're also welcome just to reach out to us directly if you want to arrange for a more one-on-one discussion or demonstration. And I'd urge you to do that too, because it is really exciting to see how you apply the filters and how do you start to answer questions that I know that you have with your own portfolio using Credit Risk Navigator. So Tom and Jeremy, I'm not seeing any more questions coming through. Any last words on your side?
It's just a reminder, and Stephen, I imagine you would have said this, but I'll jump at you or jump ahead of you.
Yeah.
There's a survey at the end. If you would, anybody who's on the line, if you fill out that survey, that really helps us improve the webcast. I've taken a number of suggestions from that survey and implement them here in the webcast.
All right, we got a couple in. We stalled long enough, Tom, to get two more questions in. One's from Walter. Will the summer months help with the lodging results?
Walter, so I mentioned that according to STR, for June, the occupancy rate nationwide was at 66%. And so I thought we were going to see the lodging numbers start to come down, or at least not increase. So I'm very shocked that we haven't seen those numbers come down. And if if it stays in the 66-70% range, I can only think that it is going to help improve that market. But again, I'm just wondering if that 9% non-accrual rate is a group of hotels that actually have gone beyond the point of saving. I think that's only something the individual banks can answer. I'll try to get some feedback on that for you. But I thought that the non-accrual rate would drop this month.
Great. The other question was just about the materials, which would be sent out to everybody in advance, like we've been doing the last few months. And if you haven't got it, you can send me a note, and I can email that over to you. So why don't we conclude there, folks? Tom and Jeremy, thanks again, as always, for excellent analysis on this interesting data set. And I want to also thank everybody who's made time in their day to join us for this webinar, and look forward to talking again with you next month. Thank you, and have a nice day.
Thank you.